All right, Dr. Hassan, welcome again. And as I said, you have 45 minutes for your presentation, and then we'll open the floor for any questions. This webinar is recorded and it's live on YouTube as well. Many researchers, inshallah, will use your material or invest their time watching it, inshallah. Thank you so much, and the floor is yours.
Excellent. Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you very much, Dr. Ahmed Al-Ghatan, for having me today. It's my pleasure. And I would also like to thank all the team with Dr. Ahmed who have been working on getting all this organized for us. It is really a purposeful group of webinars, and hopefully we can be of assistance to researchers. And obviously, I'd also be grateful to listen to your suggestions as well on my research. So I'd like to start off with talking about my study here. So this study is one of the empirical studies that was part of my doctoral thesis. And it is titled Ownership Structure and Performance Evidence from GCC Countries. There were many motivating factors, but together they make it is actually the special combination of characteristics that the GCC countries and markets have that made this study interesting to me, starting off with the highly concentrated ownership structures relative to other countries in the world in the GCC stock markets, as well as the fact that the governments are at the center of ownership networks, and that their ownership stakes are quite large, again, relative to other countries around the world. Moreover, the investor protection in the GCC countries is generally weak, even though recently there has been numerous regulatory reforms, as well as corporate governance code enforcements in the GCC countries. In terms of the economic significance, this can be reflected as well with the rapid growth of the number of firms. For example, in 2005, there were only 473 listed firms across the GCC markets, and that rapidly increased to 703 or 705 firms in 2013, and this growth is expected to continue. Examples of this can be seen in the Saudi Vision 2030, and most other GCC countries, if not all, have already set these plans and are working on them to diversify their sources of income, to expand their economies, and to become powerhouses, economic powerhouses in the region and at a wider distance or circle, should we say. And so, yeah, as I said, an example of this is the Saudi Vision, and the growth has been increasingly driven by international investors. Foreign direct investment has been increasing. So the combination of these characteristics leads to the question of whether concentrated ownership can make up for weak investor protection by playing the role of effective management monitoring, and thereby leading to better firm performance. And this is what we want to find out. So going on to the theoretical background, to start off, ownership structure can be measured by overall concentration, which would show us whether the structure is concentrated or dispersed. If it is concentrated, obviously there will be many large shareholders, and if it is dispersed, then minority shareholders make up most of the shares, and there are little large shareholders. Or also it can be measured by the identity of the shareholders, whether the shareholders, the government, an institution, a corporation, or an individual or family. There are two main sides to this idea of the effect on firm performance. One side, as like the argument is from the Schliefer and Vishny 1986, who argue that large shareholders are expected to be more committed financially than smaller shareholders, and therefore they will be more incentivized to closely monitor management to ensure a return on their relatively large investment, because they're financially committed. So they would increase the they would help firms do better. While on the other hand, other scholars argue that no, large shareholders won't be that good for firms, because they can easily exploit firm assets at the expense of minority shareholders, and that would ultimately lead to worse share performance of firm performance. So the importance of accounting for the identity of shareholders has been emphasized in the literature, and this is why this study makes sure to employ both measures of ownership structure. Moving on to the data sample, as from the title we can see that it covers the GCC countries. So it is all 6 GCC countries in which there are 7 stock markets, and the sample includes all the listed companies. And these countries are Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the United Arab Emirates. The contribution of this research lies in a few factors, the first of which is the fact that the ownership data were hand-collected from corporate governance reports, and also the fact that it encompasses all GCC listed firms, whether they are financial or non-financial, for which data are available. And the previous studies tend to focus on either or, financial or non-financial firms, not only in the GCC, but generally as well. And in addition to that, to the best of my knowledge, no previous study investigates the impact of overall ownership concentration, institutional and corporate ownership concentration in the GCC countries, while ensuring that the reverse causality issue of ownership concentration on firm performance is taken into consideration, controlled for, and the endogeneity bias issue has been taken into account. And to expand on this particular point, I would like to very quickly give a brief background. So this goes back to the Dempset's 1983 study, in which Dempset proposes that ownership structure is endogenously determined. And 2 years later, Dempset goes ahead with Len and empirically confirms that ownership concentration and structure is in fact endogenously determined, and it is determined by 3 main variables. Those are firm size, firm specific risk, and systematic regulation. So these variables are used as instruments of ownership structure to determine its impact on firm performance, while ensuring that reverse causality is taken into account and the bias does not interfere with the results. In the UK and the US, most studies that do control for endogeneity do not find a significant relationship, while those that do not do find a relationship. But then again, these studies are not necessarily generalizable to the rest of the world, obviously, with the many differences. Mainly, like one of the main differences is the ownership structures. Those are market-based markets. The UK and the US, they have these structures of dispersed ownership, many minority shareholders, and very little large block holders. So compared with the control-based or concentrated ownership structures, these studies give mixed results, and this applies to the GCC countries as well. So this makes this study interesting, and also it makes the fact that there is no consensus yet on this relationship led to the call for further research. So yeah, this is the hypothesis formulation part, and I start off with the overall ownership concentration. As we said, there are these arguments on both sides. One argument says that because large shareholders are more committed financially, then they are more incentivized to monitor management, and this will lead to better performance. But then again, not every shareholder wants to maximize their wealth. For example, you have governments who often just choose to hold shares for other goals rather than looking at shareholder value maximization. They might look at political goals or social welfare maximization, even if that comes at the expense of them, of their firms doing worse. And also we have the idea that the large owners may exploit firm assets. But the good thing is that in this study, we look at the identity of the shareholders, and this helps us determine whether the overall ownership will be positive, have no effect, or be negative. And taking into consideration the fact that the ownership of governments isn't as big as institutions, looking at the Abdullah and Ismail study in 2017 in the GCC, the institutions own bigger stakes, which is also confirmed in this study, and the fact that individual and family owners also own as much as governments. So even if the effect of the governments was negative, the magnitude and the quantity, the percentage of the ownership of the other ownership identities which are expected to have a positive effect are even bigger. So this is why hypothesis 1 is stated as overall ownership concentration has a significant positive effect on firm performance. Moving on to the government ownership. So from this part, starting from this part until the end of the hypothesis formulation, we follow the Hansman 1988 study and Peterson and Thompson in 2003, where they weigh out the costs of each owner type, whether they are beneficial to firms or whether they come with costs, and we try to weigh them out and see which is stronger to reach our hypotheses. So we can see that government owners can be beneficial because of the tax revenues they have. And the GCC, there aren't like there is tax, but it isn't like other countries, and even some countries in the GCC might not even have income tax. But this idea still applies because the tax revenues are replaced by oil revenues from the oil exports in the GCC. And also the firms owned by the government are also usually more protected because they can, the government can use their power to increase barriers to entry of the industry, and thereby, just protecting their firms from competition. But then again, whether these benefits have a direct impact on firm performance is questionable, because the costs of government ownership are large. As we said, the governments rarely target firm value maximization. They typically have other goals of share ownership, including politically motivated goals, and also they could have, they could give jobs to people who do not deserve them because of all the politics they are engaged in sometimes, and this makes them inefficient. And also there is government corruption. Obviously, that's not, it might not necessarily be the case for every country, but when it is there, it can cause serious inefficiencies in government-owned firms. And inevitably that would worsen firm performance, and therefore we state hypothesis 2, that government ownership has a significant negative effect on firm performance. Going to the institutional ownership, it is mainly benefits, just because they are financially motivated. They want their financial institutions at the end of the day, and they want to maximize shareholder value. That's what they do day and night, so that's the general expectation of them. And also compared to other types of owners, they are typically monitored more closely by external agencies, for example, banks or whoever has loaned them, or the shareholders who are invested through them. There is lots of pressure on them to do well, so the risks of exploitation or expropriation of firm assets are reduced. And also at higher levels of ownership, which is the case of the chosen sample, they have the highest levels of ownership. They have greater power to closely monitor management. They have larger says in the government. They have larger, impact when they vote. Their votes are bigger. And finally, compared to the other types of owners, they have greater amounts of resources or funds available to them, and therefore they are less restricted. And therefore, in hypothesis 3, we expect that institutional ownership has a significant effect on firm performance. Here we distinguish. Typically, the literature, puts together, not always, but typically, the institutions and corporations. They are, merged together. But here we distinguish the financial companies from the non-financial companies, following the research, following the short study and the propositions by Short and Cuban and Beach, I believe, where they emphasize the fact that owners are different, they have different goals, and therefore we look at the differences here as well. While there are some benefits on one side, so for example, the corporations have important technologies and resources, so they can help the firms that they own and by giving them access to such advantageous facilities, while also they could help increase firm performance when they own firms in the same industry, and they would be able to provide them with the unique resources that firms from other industries will not have in any case. But on the other hand, there are costs of corporate ownership. There's the possibility of corporate integration, where the firms may use that their ownership to expropriate firm assets at the expense of small shareholders. And finally, you've got also the cross ownership, where firms protect themselves from potential takeovers, and so there is management entrenchment. They could just reach agreements. The manager of company X could agree with company Y because they cross-own in each other's companies. So they would say, okay, I'll vote I'll convince the board to vote for you to remain, but in return, you also convince your board for me to remain, even though the managers are not doing well, or for example, their performance is bad. They can reach management entrenchment because of this cross ownership. So that is a heavy negative of corporate ownership. Since there are arguments for both sides, we hypothesize in hypothesis 4 that corporate ownership has no significant effect on firm performance. And finally, we have the individual or family ownership. They are put together in most studies as well, unless the other studies, unless some studies look specifically and have data for family ownership, founding family ownership, then that is a different story. But usually they are put together, like in this study, the costs that they bring to these firms include the fact that they invest large proportions of their total wealth, and they become wealth constrained, so they will be less willing to take risks. They will be more protective of the capital, and therefore performance cannot, or companies cannot grow. They're not free to do the best they can because of this. And obviously there's the family ties idea, possibly unqualified family members that are hired or executives that are overpaid. But then again, this is only applicable for in the case of the family ownership, but not on the individual ownership. Sometimes there are just individuals that own companies that they do not have any family ties with. So this is where the benefits, the strong benefits, come into place. There's because they invest large proportions of their wealth, they are expected to be more incentivized to monitor management closely to ensure good firm performance, to protect their wealth, because they put most of what they have. They don't want to lose it. So they take it even more seriously than other types of owners. This is the argument. And the other argument is that another reason for them to be more incentivized is that as owners, they directly represent themselves, unlike other owners where you have indirect representatives, for example, in the example of all other types of owners. And these strong reasons are applicable to both individual and family owners, and therefore we hypothesize that individual or family ownership has a significant positive effect on firm performance. Moving on to the variable definitions, the very first two variables we have here are the two market-based performance measures, Tobin's Q and the market to book value of total equity. So these are our dependent variables in this study. And the next five here, we have all of the ones that end with OC, ownership concentration, are the main independent variables in the study. So first we have the total overall ownership concentration. And the reason we use the shareholders owning at least 5% is that this is what the data gives us. This is what the data that are available allows for us to get. We cannot get those for lower. They are not disclosed in the GCC stock markets. They are not required to disclose them. And this measure of ownership concentration has been used as well repeatedly in this line of research. Next, we have the government ownership, the total ownership by institutions, corporations, and individual family shareholders. Following this, we have the control variables. So we start off with leverage, sales growth, firm age, and we transform this to its natural logarithm to control for the non-linearity of the relationship between firm age and firm performance. And we have the capital expenditure scaled by total sales, free cash flow scaled by total assets, and firm size, which is our instrument. I will go through this, I think, in the next couple of slides, and its natural log. And finally, we have the industry controls and country controls. And because the average firm performance by industry and country have high multicollinearity from the preliminary results, we center them both. And finally, we have, so these are the country level control is time invariant. And for robustness checks, we have finally the three additional variables, which are time variant country level controls to control for country differences using another way to confirm the results. So the regression models, we have, we use instrumental variables. As we said, the literature highlights the significant evidence on endogeneity in the ownership structure and how it is important to control for it. Otherwise, we'll have biased results. The fixed effect models have been used before, and although they do deal with the potential heterogeneity of ownership structures among firms, they do not control specifically for reverse causality. And therefore, one plausible method is the instrumental variables approach. But it is also very important to note that this approach can be difficult because its success depends greatly on the strength of the instrument used. One ideal instrument for the current situation is one that impacts firm performance only through its impact on ownership structure. And the instrument must not be correlated with the error term of the performance equation, and that is for it to meet the exclusion restriction. In order to ensure that the instrument is viable, we look at the literature. And once again, as we said, the Dempsey and Len study in 1985 find that firm size is one of the main determinants of ownership structure. And therefore, we follow the aforementioned studies, including the Himmelberg et al. 1999 study and the others, as they used it to predict the values of ownership structure first in the first stage, and then in the second stage, estimate the performance equation using those predicted values by using, the very start in the first stage by using firm size as the instrumental variable. And this is what we do right here. This is our simultaneous equation model, where the top model is the main performance equation. So here we have FP for firm performance, and here's the main independent variable, ownership concentration, and then these are all the controls, including the year control, year dummy control, and the country level controls and the industry level control. So as we said, the ownership concentration is endogenously determined. So we would have to get the predicted values for this first. So the first stage regression is stated as follows, where all the controls have to be included as well, but mainly the natural log of firm size is included as the main predictor of ownership concentration to instrument ownership concentration and retrieve its predicted values so that endogeneity bias is removed or mitigated, sorry, so that it is mitigated. So after we estimate these equations using ownership concentration, we replace ownership concentration one by one with the identities, government, institution, corporation, and individual or family ownership concentration one by one using both stages, and we apply this respectively. Finally, the capital expenditure scaled by total sales and the free cash flow scaled by total assets are used to control for growth opportunities and available resources respectively. And this helps us ensure that the instrument is not correlated with the error term of the equation, hence meeting the exclusion restriction. The data collection and sample. So here we have just a quick description of the data. Data were manually collected from the Thomson Reuters ICON database, and the ownership data in particular were cross-checked with the corporate governance reports provided the respective stock exchanges websites were available, provided by them, sorry, yeah. And the results reported cover all firms that were listed on all stock exchanges in the 6 GCC countries during the 5-year period, covering the years 2012 to 2016, again, where data are available. The total number of firms listed between those years was 734. And because we have, missing data in some firms that have been suspended from trading, or others that are, duplicates because they are cross-listed on more than one GCC stock market. So we have observations that are dropped, 607 firm-year observations to be specific, and therefore the final sample yields a sample of 3,063 firm-year observations. Finally, following the literature, there are potentially problematic outliers in the variables and the observations specifically, and therefore we winsorize all the variables at the 1% and 99% levels. Here's just a quick table to reflect the distribution of the number of firms by country. So we have the largest number of firms is in Kuwait, although the Dow Stock Exchange in Saudi Arabia is bigger in terms of market capitalization, but the number of firms in Kuwait is higher. And then we've got in third place, we've got the Muscat securities market in Oman, 110 firms, and followed by the 2 stock exchanges in the Emirates. And finally, we have Qatar and Bahrain at 42 and 40 firms respectively. These are the number of firms that are in the final sample, the 663 listed firms that are included in all of the regressions. Here we have a quick table of the descriptive statistics. Once again, top 2 variables, Tobin skew, market and market to book value of total equity. These are the 2 market-based measures of firm performance. Nothing surprising here. The 1.249, very close to that found in previous studies, even compared with, especially compared to those studies in the GCC markets. We have the ownership concentration as expected. Ownership structures are highly concentrated. The average is 50.9%. That are owned by large shareholders. So, more than half the market is owned by large shareholders. And this is only looking at, the 5% threshold as well. Could be even higher. Other shareholders could have 4, 3, 2%, which is also, significant stakes, especially in the bigger companies. Looking at the government ownership concentration, they own 11% on average, and the institutions are the highest owners, with 19% on average, 9% in corporations, and individuals and family owners own on average 11%, which is quite similar with that of the government ownership level. Here we have the firm size. Obviously, I think this is in millions, and we have its natural log, and we have leverage, sales growth, and firm age. Firm age, the average age of the firms is 14 years, with the youngest firm being 1 year old and the oldest firm being 38. But once again, there are many companies that are much older than that. But the measurement we use here is the age since the initial public offering. So it's not since the establishment date, but we try both measurements of the variable to ensure additional robustness, and our results are unchanged. Finally, we have the country level and industry level controls here. This is the correlation matrix. We try to ensure that there are no dangerous correlations of 0.8 or above that are significant, or minus 0.8 and below. And we can see that we have one just right here, 0.83, which could be problematic, but looking at it, it is that between Tobin skew and market book value total equity. So this is this is expected. They are both measures of the same firm performance dependent variable, and they are also not used in the same equation. So it's either Tobin skew as the dependent variable, or in another equation where we estimate for additional checks, we replace it by market book value of total equity. So this is our regression. Overall ownership here. This is the first stage, and as expected, the larger the firm, the lower the ownership concentration. This is the instrument, and this is the instrumented variable. And then in the second stage, the predicted values of ownership concentration are replaced to retrieve these estimations. And we can see here that there is overall ownership concentration has a significant positive effect on Tobin skew at the 5% confidence level. What do we have here? Yeah, we've got, as expected, the free cash flow has a significant positive impact. Yep, and going on to the next slide. Excuse me. Yeah, going on to the next slide, we have ownership by identity. So here we have the government ownership concentration, and as we hypothesized, it has a significant negative impact on firm performance at the 5% level, all of them. Here we have institutional, corporate, and individual or family ownership concentration, all of which have a significant positive impact on firm performance. Once again, to ensure that our results are robust, we re-estimate these models using an alternative measure of market-based performance. Excuse me. So here we have the overall ownership, same first stage, obviously. Second, in the second stage, we reach the same conclusion, same result of a significant positive performance effect of overall ownership concentration. This time at the 1% level as well, and same here. So the government ownership concentration has a significant negative performance effect, while the others have a positive significant performance effect, just as the previous estimations. So we run endogeneity tests, which we use both the Wu-Hosman F-test and the Durbin-Wu-Hosman chi-square test, and both of them confirm that ownership concentration is indeed endogenous. And we also test for the strength of the instrument in each of our estimations. And in all cases, it is the F statistic is greater than 16.38, and this meets the most restricted threshold of the stock in the over 2005 weak instrument test. As we just mentioned, the results are robust against both market-based performance measures. And as an additional robustness check, when we described the variables, we went through the national governance index, 3 variables from there, an aggregate of them, and the gross domestic product by country and the foreign direct investment by country. All of these are time varying control control variables, and these are included just to ensure that the results are not driven by such country level differences. So these replace the average performance by country, and once again the results remain similar. So in terms of the conclusions, hypothesis 1 is accepted, and the evidence supports the view that concentrated ownership structures improve firm performance due to closer management monitoring, even though we have weak investor protection. So the large shareholders, based on these results, are playing the role of the investor protection laws by closely monitoring management, ensuring that there is a financial return on their investments, and the minority shareholders are getting their share as well, because looking at the market-based performance measures, everyone is a winner if the performance is high. Then even if whether you're a minority or a majority shareholder, everyone is doing better. In terms of the identity effects, the first equation includes government ownership as the main independent variable, and this shows to have a significant negative impact on performance, and this is consistent with what we expected. And this view is in line with the argument that governments don't typically want to maximize their wealth or value by acquiring shares in firms, but they have other goals, usually social or political objectives. And as expected, the institutional ownership had, we expected them to do to improve firm performance because of many reasons, and this finding is in line with what was predicted, and also in line with the theoretical suggestions that we based our hypotheses on. Moving on to the corporate ownership, this is quite an interesting finding here. We reject the hypothesis 4 because we found a significant positive relationship, while we expected no relationship. And one plausible explanation for this finding is that the entrenchment costs of cross-ownership do not apply to the GCC listed firms, because cross-ownership is almost non-existent in the region. While on the other hand, horizontal and vertical integration and the hierarchical structures are considerable and can be seen in the GCC listed firms, and these usually provide relevant firms with unique resources and advantages, and therefore the benefits outweigh the costs in the GCC, seemingly from the results here. So we find that this is positive as well. And finally, the individual and family ownership and performance, the effect is found to be significant and positive, and therefore we accept hypothesis 5. And once again, because of this is in line with the theories and the arguments we went through, including the idea that because they invest larger proportions of their wealth, they are more protective of their wealth. They want to make sure that they do not lose their invested funds, and also the fact that they are direct representatives of themselves. It makes them closer to the companies, makes them better monitors, and therefore they evidently improve firm performance. Yep. Going on to the limitations and ideas for future research. The focus in this study was on external share ownership. And that is one limitation of this study. It is one of the main limitations. Actually, we were interested into looking at internal share ownership, but the data ownership data were quite difficult to retrieve. But future studies, given data dependent, could look at the influence of managerial and board member share ownership on firm performance in the GCC listed firms. And also another interesting idea is looking at the differences between domestic ownership and foreign ownership, and looking at or investigating the performance effects differences between each. Yep, I think that's us. Yep, perfect. Thank you very much for your time, everyone. If you have any comments or suggestions, they will be much appreciated.
Thank you so much, Dr. Hassan, for your presentation. Actually, it's so useful, and I enjoy really watching you presenting your PhD and your paper. I have many questions actually, but let me start with the guest. Please, if you have any question, please raise your hand. I know there is some question in Q&A. I will get back to it. But if there is anyone want to talk to or ask Dr. Hassan directly, please raise your hand so I can open the mic and you can talk to him directly. All right. So we have a question from Dr. Belhaj Ramzi. Thank you, Doctor. In accounting research, we build a hypothesis based on theory or based on the literature. How do you build your hypothesis? Actually, it's one of my questions.
So yeah, going back to the hypothesis formulation, here I present mainly the theory, but actually I build it on both. But just because I wanted to, not exceed the time limit, I do not include everything here. But I also look at the previous studies, especially in the GCC context, to also, lead me to the hypothesis development section.
Which theory do you use, Dr. Hassan? Which theory have you used?
Yeah, so in terms of the framework I use, it's the Hansman 1988 and the Peterson and Thompson 2003 studies. They use this way in which they weigh the costs and benefits and see, which has stronger side, stronger magnitude to reach their hypotheses. But I also mix that, as I said, with the previous empirical research as well and findings in the GCC countries. Once again, before these two, the main theories I use. Okay, sorry. You might be looking for the answer of agency theory, and obviously, yeah, this is all based on agency theory. Yes.
Oh, yeah. This is my question actually. Yeah. So you used agency theory for to build your hypothesis in, right?
Yes, correct.
Do you use other theories or just mainly agency theory?
For this particular study, it is just agency theory. Yeah, I do have other studies in which I encompass resource dependence theory and stewardship theory as well. But yeah, no, and this one is just agency theory. So
let's focus, Dr. Hassan, in this paper. So we don't want to lost or and so in this paper you just use agency theory. So yes. Dr. Belhaj Ramzi, so the answer is Dr. Hassan used agency theory for building his hypothesis. Okay. Also, Dr. Aya Mu'taz, thank you for insight session. Would you please give a general comment on the agency problem in the different ownership structure in the study?
Yeah, so I'm sorry, can you repeat the question, please?
Sure. Would you please give a general comment on the agency problem? Agency, they have a problem between the ownership and the management. So can you give us a general comment on the agency problem and the different ownership structure in the study?
Excellent. As we said in the limitations of the study, we do not look at the internal ownership structures because of the limited data availability. So in the agency problem, the researchers in, I think 2010, I think it was the Villalonga and Amit study, in which they proposed that there are two main agency problems. The main agency problem number one, they call, is the, as you just mentioned, Dr. Ahmed, is the idea that there is this, clash between the owners and the management. And just because here we don't look at management ownership, we cannot make conclusions on that agency problem. But there is the other agency problem number two, which they call, in which the clashes between majority shareholders and minority shareholders, and this is what we focus on in this study. Looking at that, if that problem, agency problem number two, is present, then obviously the large owners will be of no good, as they may exploit the firm assets at the expense of smaller shareholders, and that would lead to lower firm performance. So we find evidence that large owners in the GCC countries actually help solve agency problem number two, because as some theories say that they are expected to exploit firm assets, but we find evidence for the opposite, that they are more incentivized to closely monitor management and they improve firm performance, and therefore they are actually protecting the minority shareholders, bringing us back to the main question of whether the concentrated ownership is making up for the weak investor protection by playing the role of effective management monitoring. And in fact, it is for most identities, with the exception of government ownership, which we found to be negatively associated with bad performance. And obviously, that was due to the reasons we have already mentioned. Because of their goals and objectives, which are different to other owners.
Totally understand. Thank you, Dr. Hassan. Also, additionally, she has another question. Additionally, do you believe that firms that have the government as a majority shareholder contribute more in positive externalized and less negative externalized, such as pollution?
Yeah, I think that is a question directed more to corporate social responsibility, and it might be beyond the scope of this research, but it is an interesting question, and I'll definitely have a think about that. Thank you.
Yeah. Totally agreed. عندنا غيداء السالم. I know this study, maybe it's a part from your thesis, so if you have a question, you have the opportunity to ask Dr. Hassan. If you have. All right, Dr. Hassan, I have some questions. First of all, I want to thank you for your hard work. I know maybe some from the audience don't know how it's hard to collect this data, especially in GCC, or mainly in the about the ownership. It's so hard. I don't see actually any study that talk about ownership in GCC. Yeah, there is in Kuwait, there is in a developed country a lot, but in GCC, I don't think I saw. But actually, I was wondering if you waiting for some study in GCC, like there is, for example, Dr. Shimri, I think Shimri, also Dr. I forget his name, Saad أعتقد الشمري. Also, they are or Saidi as well. If you search on the ownership, you will find some research. They are talking about mainly in ownership. So it will be great if I see some of those names that will talk in ownership, especially in GCC. Or one of those countries like Kuwait. Yes, you have some like Al Hadi, he's Omani. and he is one of key authors in your in GCC talk about the ownership. But it will be great if there is others, to support your hypothesis or to see how it goes. Also, I have some question regarding the data. How, like, you collect the financial and non-financial firm. So I was wondering how you make a model or collect both the financial, and both of them have different code or different policies. One of them, the financial under the central bank, and the other have its code. Also, different countries have a code, or the other one doesn't have code. So why you merge them? So if I think it will be great if you make a study for a financial and the other for non-financial, and then maybe you compare with them. It will be so good. But both of them, I don't know if you have an answer for this question.
Yeah, so one of the main reasons I went ahead with this is the fact that usually the studies focus on one or the other, and as you mentioned, Dr. Ahmed, the main reason they do that is because of the vast differences in the codes that are, for example, the accounting principles that are maybe enforced on them. But when I went into detail and I even compared, for example, the financial sector, I looked at the real estate sector, if you consider it as a financial industry, in the financial industry, and I looked at the investment companies, insurance companies, banks. Even those industries, they have big differences between them. So even focusing on financial or non-financial, we still have that issue. And that is why we came to the agreement that having them together is the same as having one or the other. Otherwise, we could just study, one industry and stop right there. So obviously, how we made sure that the differences don't drive our results and cause bias in them is by including industry level variables. And also,
Dr. Hassan, sorry for interrupt. The problem is not about the analysis and this stuff. It's about the main thing. The code itself is different. So let me give you a hint to answer this question, or to find, maybe if you have an answer, you will help me as well. If you find a paper that gather the same details, the same data, financial and non-financial, and you can say, for example, I am collecting this and this following X.
Excellent. Yeah.
This is a good answer. Do you read any paper that do the same?
Oh yes, yeah, there is definitely, but I'll have to go, try to retrieve that.
So, at least you need to close some doors, don't open the door for other. Also, I was wondering, when you talk about the ownership and this stuff, one of a main characteristic, for example, and one of the hot topic, let's say nowadays, which is diversity. So if you talk, for example, the percentage, you talk about the family firm and this stuff, yeah, that's good. But what about the female, the percentage of the female? It's one of the interesting questions.
Definitely.
Also the royalty.
Mm-hmm.
What is the percentage of the royalty in this company? The shareholders.
Mm-hmm.
Okay. Also, do you want to answer, or it's?
Yeah, no, it's a great idea. I'll take it into consideration, and perhaps I could incorporate it in the future.
Yeah. Also, Dr. Hassan, I notice you have so many hypotheses. I am definitely sure the journal or the editor take all of these hypotheses in one paper. So I really recommend you to cut it to 2 paper or 3 paper. one paper at least have one hypothesis, two hypotheses, max three, but you are up to 5 or 6. So that's a lot. That's a lot. There is some good, very good hypothesis, like the last one. I think it's significant as well, which is the family fair. One of good question. You can make it in one paper, and you have, I think, the hypothesis number 1 and 3. I think it's the same, but it's diverse. Like one, it's effect, and the second one is not effect. I think the hypothesis number 1 and 3, I believe.
Yeah, hypothesis number 1 looks at the overall ownership without looking at identity.
And the number 3?
3 is institutional ownership.
I see. Number 4 maybe?
Corporate ownership.
Corporate, all right.
Yeah, this is government.
So what I meant, try to cut them in different papers. Don't do all of these in one paper. حرام يعني راد الصراحة. Okay. Also, you measure the performance in token Q, and the other one what? OC.
The market to book value of total equity.
This is market. I think this is a measure for the long term, right?
Yes.
All right. So you have two variable for measure the performance for long term. So why you didn't measure in short term? You have a lot of variable to measure performance in short term, like ROA, ROE, and others. So
yeah.
Also you need to put it in your mind to يعني. It's one of your big question. Why you didn't measure the performance for a short term? Token Q and the other will measure the performance for long term. يعني after 10 years, after 20 years, yeah. But short term, it won't measure it.
Mainly the argument for the choice of not including accounting-based measures of firm performance is based on the Dempsey and the Longer study in 2001, in which they emphasize that the main difference between the accounting-based measures and the market-based measures is the what do you call it? Is the time perspective. The accounting-based measures being backward-looking, while you know they measure past values of firm performance, while in comparison the market-based measures they reflect an estimation of the future results and what they are expected to be. And because we have a reverse causality issue in this equation, we do not want to make it worse by having the dependent variable measuring past values, because these might also be the probability of them determining ownership structure would be even higher. And yeah, this is the argument. They
have you tried now? Have you tried?
Yes, yes, I've tried the return on assets as the main independent as the main dependent variable, and the results are not robust. Some are the same, some are not. But then again, I believe that endogeneity bias becomes worse with it. And also, finally, Tobin's Q is used in the majority, if not the vast majority, of the studies in this kind of research. So yeah, this is why I want to make sure that my results are comparable.
Of course. But why I ask you, because it's available. It's easy to have the ROA and ROE in most of the database. So it's
yeah, and I didn't mention it as well, Dr. Ahmed. So your question is exactly in its place. I should have mentioned it. Apologies.
No problem. Doctor, how you measure the firm size? One of your variables is firm size. So may you tell me how you measure the firm size?
Yes, it is the total assets.
By total assets, okay.
Yes.
Okay. There is other measurement for firm size, like the number of employees, for example, or others variable. It might be one of your contribution in your study.
Good idea.
So what did you do in a company? أنا قاعد أسأل the companies, for example, what is your period?
5 years, 2012 until 2016.
2011 to 2016.
12
to 2016. So it's almost 4 years, right?
Yes, 5 years.
5 years. Okay. So let's say we have a company X. It was in the in the stock market in 2012 and 2013. Then it's withdrawal or bankruptcy or something happened to it in 2014. So it's not, you know, in the market for all the from 2012 to 2016. What did you do in this situation?
Yeah, I included them just to ensure that there's no, you know, sampling bias, and it's not necessarily like, it's not very important for the panel to be balanced. It could be unbalanced. So I thought that, you know, I wanted to avoid bias. So I just, you know, left for every year where there is information or data, I left it in the sample, and whether the data is missing, then I would remove it from the sample, but not totally, you know. So if it's available for 2 years, then I would leave the 2 years, and yeah.
Yeah. My last question, sorry. UAE have, I think, 2 stock markets or 2 boursa. So you choose, I think, one. What about the other?
Yeah, no, both are included, actually. Both stock markets.
Both stock markets. Okay.
Yes, Abu Dhabi and Dubai.
Yeah. Okay. Sorry, I didn't know. So both of them, let's say, will have 18.8. Right, 18.8. So that we conclude to be the third.
True. Yeah. Actually, good point. I didn't focus on that. 17.5, which is the third over. Yeah. Good point, Dr. Ahmed.
That's it. Sorry for a lot of questions, because I really like your topic and really I enjoy it. And plus, I really appreciate, as I said, your hard work. I really know it's so hard. I tried to collect the data for Kuwait before, like 5 years ago, but it's so hard. So I exclude the whole variable because of that. So thank you really for your hard work, and also I want to thank you for your time. If you have any last word, Dr. Hassan, before we end today's session.
It has been my pleasure, Dr. Ahmed Al-Gattan, and everyone who has attended today. I really appreciate all your comments, suggestions. They were very helpful, and I will take them. I will surely take them into consideration. And finally, I would give special thanks to Dr. Ahmed Al-Gattan for all his efforts for organizing this excellent group, in which, you know, there are weekly webinars, and we are really, you know, interested and you know, attending it. We are finding it very useful. So I hope we continue. Thank you very much.
Thank you so much, Dr. Hassan. We're really pleased to know you closely, and we hope you have other session with us in ITAR. Enjoy other presentation with you. Thank you so much. Also, I want to thank all the guests today who are watching today webinar, and inshallah the next week we have other guest speaker, inshallah. Thank you so much, Dr. Hassan, and see you next week. Assalamu alaikum.
Thank you. See you. Wa alaikum assalam.